Welcome to the Permanent Podcast, real talk about owning, operating, buying, and selling small businesses. The reality is that businesses are made up of people, and people are messy. So, how do you navigate such a messy and complicated landscape? Well, let's talk about it on the Permanent Podcast. Hello. Okay, today we're talking about market conditions. Can you hear my washer and dryer running? It's very loud where I'm at. I'm in my basement. We're talking about market conditions, and more specifically, the market for selling a company as we're seeing it play out in 2023. Is 2023 a good time to sell a company? How does 2023 compare to how the market has looked in the past? And while this is a conversation that has a lot in it for someone who's thinking about selling a company, I'm not selling a company, and I thought the conversation was really interesting. We touch on what's behind the current market psyche, what makes for a good investment, who permanent equity is competing with, and why we do things the way we do them. So I'm talking with Emily Holdman and Tim Hanson. Emily told me that she looks at between 1,000 and 2,000 companies a year, and she's been doing this for 15 years. Tim used to work in the public markets, and now he's Permanent Equity's Chief Investment Officer. So let's jump into a conversation with Emily and Tim, how to sell a company in 2023. Hi, Emily.
Hi.
How you doing, Tim?
I'm great, David. How are you?
Oh, I'm doing wonderful. Okay, let's talk about the market for someone who is thinking about what comes next for the company that they own. What does it look like for sellers the last few years? And what does it look like right now? How can we be helpful to people trying to figure out what comes next?
I think the last few years have been particularly confusing because a lot of companies had somewhat of a disruption in some capacity in 2020. And then in 2021, we saw a record year of investment across all categories. So there were all types of deals being done. And, a lot of small business owners in particular hear about transactions among their peers, among their friends at the country club. And so you're hearing sort of anecdotal information on top of the broader news headlines. And it can be confusing, again, to figure out what reality looks like. And our opinion is that 2021 was a distortion of reality for everyone. So there were a lot of deals that got done in 21 that likely will never be done in the future and historically weren't likely either. And so it was just a confusing period of time. And then last year, you saw things start to slow down and return to what I would say is normal, right? Where you're starting to look at broader history of a business. There were businesses in 21 that were being sold based on 3 months of performance looking backward and 3 months of performance looking forward.
Is that not normal?
And that is not normal.
What's the norm? So you have to talk to me. I know very little, and hopefully I'm not condescending to people who know more. But
Right. Well, it's more common that at least you're looking at the last 2 to 3 years. Any business can have one big project or one big event. And what, as an investor, you're looking for is how are you systemically set up to continue to grow? So in that way, you have to see that happen over some period of time for it to make sense. And so 21 was just an oddball in that.
I mean, to Emily's point, it was just a weird year. Like when you're thinking about things as an investor, there are basically two things that drive your success or not: what you buy and what you pay for it. And ideally, you're buying good things at reasonable prices. And we saw a decking company that had forever been heavy on inventory and had been outcompeted by Home Depot and Lowe's for many, many years. And then during 21, with all the supply chain issues, obviously Home Depot and Lowe's, they were out of stock of lumber. And so this decking company was able to sell through years of inventory that any other company probably would have written off as obsolete. And they had a record year and they wanted to get paid for it. I understand where they're coming from. If that were me, I would want to get paid for it too, right? But as an investor, that's a hard pill to swallow, so to speak, because they're never going to have that year ever again, and you can't pay for it.
it's almost like, as the sports analogy to me, the player who had a 3-year contract in years 1 and 2, he wasn't great, but year 3, he was lights out.
The contract year.
And now he wants to get paid.
No, he wants to get paid. Well, and the problem is, too, and I heard many stories last year of kind of a Jekyll and Hyde situation where you had someone who did make an investment that bought into the trajectory that they were in 21. And then the deal is done and the capital stack is what it is. And they have high expectations for growth. And then to Tim's point, the circumstances change and, operations go back to normal and the trajectory starts to look more plateaued. And for the organization, that means major pressure because that's not what the investor was looking for. That's manifested into all sorts of changes in operations, from all of a sudden the whole leadership team is being changed out, to changing, sort of cost structure and operational priorities to things that are working for the deal that was struck, right? As opposed to what will serve the business long term. And so, it's a point in time deal. And to Tim's point, if you want to get paid for a point in time, you can, but the long-term ramifications for the business and for your team are real. And I think we're seeing more of that. And I think we will see more of that in the next couple of years, just because of the amount of debt on some of these companies that did deals in 21 and just how things have changed.
If you think about it, if you own a business and you go to sell it, obviously it's a huge life-changing event. You spent your life building the business. You're now monetizing it in some way, and there's going to be life for the business after you. Maybe you're still involved, maybe you're not, but you probably still have a vested interest in how that business does. And, again, I understand it, but I don't get it, which is why when it comes to that event, sometimes the number one variable that people try to maximize for is the valuation they get or the amount of money they get to sell it. And, there's that old saying, like, don't let the tail wag the dog. When it comes to selling a business, I would say, like, don't let the valuation tail wag the good decision dog, especially if you're going to be around post-close. To Emily's point, you're going to care who you work with. You're going to care what they're going to do with your employees. They're going to care how, they treat your customers. The public stock market was at all-time highs. And so there's another bit of calculus. We're expecting 2023, maybe 2024 to be a slow year for deals because valuations are down. But think about if you sold for a very high multiple and then went and dumped your money in the stock market because you had nothing else to do with it. Now the stock market is down 25%. So if you sell, maybe you get a lower, a turn less, you get 5 times instead of 6 times. But if you're going to go put your money in a different investment, you're diversifying, because you said taking chips off the table is maybe one of the reasons someone might make this decision. It's a much better time to take chips off the table and put them in other chips.
Right. Things are cheaper.
Right.
Right.
So, there's a whole wide world of context out there when it comes to making a big life-changing decision like that. And I think it's important that as people think about making good financial decisions, you make them within that universe of context and not just, hey, I'm trying to max my valuation. Because if you max your valuation now, to Emily's point, but end up with a debt-laden company or a company that lays off our employees and you maybe rolled equity forward, the value of that stuff is all going to be impaired long into the future simply because you tried to maximize an outcome at one single point in time.
Well, and the conditions for why that thesis worked, right? So like a lot of times the reason that high multiples will be paid is because they're putting multiple businesses together and there are quote unquote synergies to them, right? So when
tremendous synergies.
You put your hands together in the synergy symbol.
There you go. And when they do that, the issue is if market conditions change as they have, that can be super challenging because now sometimes the things that you put together no longer make sense. And so if you turn out to be the thing that was added, right? Because the highest multiples are generally paid to things that strategically already fit into something that they own. They may be quick to shed or quick to shift priorities, none of which are going to be good for the long-term potential of the team that you built and the business that you built over a long period of time.
Dirty little secret of mergers is that 90% of them fail to achieve pre-merger expectations.
Really?
Yeah.
It's kind of like when you buy and put your name on the stadium. You usually are not going to be in business for the contract of that stadium.
That is another indicator, yes, as the lovely people at FTX Arena down in Miami have learned.
Sign manufacturers again. I bet they're doing well.
I want to talk about the psyche of the market. It's impossible to open up. For me, I open up the Wall Street Journal app. I have a buddy actually who still gets the printed paper. He's 40. He's not even an old guy.
I love that.
Still gets the printed paper. Sometimes we're on a text chain. We'll send, a link to an article or something. I'm a Peggy Noonan fanboy, so usually I'm just sharing Peggy Noonan's op-ed column.
Are you really?
Yeah. Huh. Love her writing, her tone of voice. Anyway, I'll send it to the group. And you're like, oh, this is so good. And he won't respond until that Saturday when he gets the printed paper, at which point he'll take a screenshot and say, yeah, that was good, of the article. It's impossible to open up the Wall Street Journal, read the Wall Street Journal without seeing something about layoffs, of recessions coming, big banks predicting a recession. That has to do something to the psyche of someone as they evaluate their company and exploring a sale.
It's not directly relevant to most small businesses. The small business adjustments aren't going to make the headlines of the Wall Street Journal. There are trends that we're certainly paying attention to. I mean, B2B software in particular is being shed and cost structures for enterprise level companies are being scrutinized. And when that happens, Small business vendors are going to be hit just like everybody else. And it's also true that there are certain segments of the population that are not spending the same way they were when they were stuck at home for a year and a half.
Yeah, I mean, the thing about predicting a recession is that you'll eventually be right. So someone's always predicting one.
I've been saying this for 8 years.
Right.
Finally right.
You'll eventually be right. And I mean, Emily, how long does it take for someone to gear up to sell their business?
Right. It's usually 2 to 3 years.
Right. So, I mean, by the time you get your books in order, engage a intermediary, get your deck put together, socialize it with potential, a long period of time goes by, and a lot can change in the world in that period of time. So you think you're timing the market by not starting to sell now because we might be going into recession, or if 2 years ago you started the process because valuations were at all-time high. Well, congratulations, now you're ready to go. But again, if you want to make a good decision about selling your business, it's always a good time to start thinking about it. Conditions be what they are, as long as you're reasonable and are optimizing for multiple things. But to Emily's point, we had significant inflation last year, 2022. The exact amount will be debated by economists and smart people for many, many years to come. But what that led to was the Federal Reserve raising interest rates. And the reason they raise interest rates is because it increases the cost of borrowing, slows down the velocity of money, ostensibly keeps prices tamped down by slowing economic activity. When you raise interest rates, obviously federal government debt is completely creditworthy. So if you can get 6% investing in government money, then in order to take the risk of investing in an illiquid small business, you're going to ask for way more than 6%. So, if you pay roughly 12 times for a business, you're going to make 6%. If you pay 10 times, you should make 10%. If you pay 5 times, you'll make 20%. And so as the risk-free rate ratchets up, the multiple that someone will pay for your illiquid small business is going to decline exponentially in order for those return profiles to be basically parallel from a risk standpoint. So if I can make 5% risk-free, I'll probably want to make at least 15%, maybe 20% on my small business investment, because otherwise I'll just take the sure thing, 5%, and go on my merry way.
Usually, at least some of their debt is coming from a bank. And the banks also have options. So the bank's willingness to lend and willingness to underwrite the small business also changes. And it makes it difficult. And it was very difficult in Q4 of last year. A lot of deals fell apart because the banks said, no, we're not funding the debt on that deal. And the investors were not prepared to write equity checks to cover sort of the delta between what they were planning to put in cash and the debt that was no longer available.
I mean, to illustrate the gravity of that, in Europe over the prior to the current period, in 21, 22 for a little while, the savings rate, interest rates were negative. So in order, you actually had to pay money. You lost money to have a risk-free investment. And so that's why you saw everybody just stretching for any kind of return at all, right? Because in order to just keep pace with zero, you had to take a lot of risk. That's completely reversed now. Venture is probably there's a lot of ways to define risk, but venture investing is risky in the sense that they're young, unproven companies that are probably unprofitable, probably burning cash, which means that they need to continue to raise money in order to be a going concern. And so one risk factor, for our businesses, they generally generate cash. So if banks don't lend, it's cool. Maybe we can't grow as much as we wanted to, but the business is generating cash to pay its employees and so on and so forth. With a business that's not doing that, you're relying on an external stakeholder, a lender, an investor, to continue to feed you money so that you can just continue to exist, just to have the status quo. And in a return environment where the risk profile and the return profile changes so dramatically, that dries up really, really quickly, which is why those valuations and those layoffs are happening so violently compared to the rest of the economy. It's because it's not a symmetric risk pattern. It's not like the Y = X linear.
It's almost a 180 turn. The major investors on the venture capital side are telling all of their companies, you have to focus on profitability for all the reasons that Tim just mentioned. You've got to be able to pay your own employees. You can't rely on the markets to give you cash anymore at the magnitude and in the way that they were before. That's why they're making the headlines, is because they're now having to tell all of their companies, you need the operational rigor that small businesses are much more used to, right? There's much more scrutiny on a P&L for a small business than oftentimes on a venture-backed company because, sort of profitability be damned.
Which is insane.
Scale. It is insane, but it's been the case for over 10 years.
We're just a peanut gallery here in mid-Missouri, so who knows?
And they did
We
well
got a 360 view of the whole country. We're right in the middle.
We can see it all.
That's such a good point.
We're like the Eye of Sauron.
Yeah, there you go. That's definitely the metaphor we want. We're like the evil, whatever he is. I actually want to lean into this whole 360 view. I actually kind of like it. We've seen lots of companies, as we've established at the beginning of this. And for context, permanent equity doesn't have a specific industry thesis, right? So we just will invest in any company that's profitable and growing, whether that be plain parts business or all the way to an executive matchmaking company, right?
We try to look at businesses that are excellent at what they do.
Great.
Yeah.
That's well put.
So it's not any business.
Well,
it doesn't have to be growing.
So hold on. No, it's actually worth diving into because I think, we look at businesses that grow at a wide range of rates and sort of their total opportunity set can be pretty wide ranging as well. If you, again, make the comparison to venture is looking for the unicorn. They want $1 billion companies or way more. And for us, that doesn't necessarily have to be the outcome that we're optimizing for, but we want to see that there is opportunity for growth for that business, right? So in, kind of the value investing landscape, there are models where you would buy something that will naturally decline. That is
cigar butt.
It's called a cigar butt. Yes.
Investing parlance.
Okay.
And so we are not looking for cigar butts as an example. So you can have a profitable business that is a cigar butt. The sort of demand for the market is softening and it will eventually go away, but it might take a while to
This is like
support.
beepers, in the
Right.
late 90s.
Right.
Like it was totally fine to have you had a very profitable cash-rich pager business.
And you can kind of, go along for the ride on the way down. And so that's a model that exists in the market. It's just not what we do. So I think the distinction is that we look for businesses that are set up in such a way that they have opportunity for growth, right? So if the only way to sort of grow the profitability of the business is to continue to cut cost structure, that's not a business that we would be interested in.
Okay, that's great.
We want businesses that have opportunity for expansion.
Okay, well, with that in mind, then, I still want to kind of get your 360 take on how you're seeing the different industries play out.
Yeah. So I would say that there's been sort of zigging and zagging, to use Tim's language.
Tim loves that.
I know.
That's
Well, because when I start talking about uncorrelated assets, everybody rolls their eyes at me and tells me to shut up.
Fell asleep in those 2 seconds that you said that word.
I think zigging and zagging is a better technical term than uncorrelated assets. So we'll go with it. So zigging and zagging. So if you look at consumer as an example, consumer services are through the roof, whereas consumer goods are not. And there are lots of reasons as to why, but a few of them would be that consumer services generally are higher margin. You're not carrying inventory. And the market for that is largely based on consistent demand. So think about HVAC, pest control, those types of things.
Yep.
The private investment market has become interested in those things over the last decade in a much bigger order of magnitude than we saw when we first started looking at those companies almost a decade ago. Part of their rationale for that is that you can have a network of them that is all over the country, right? That then can be sold as a bundle because there's lots of earnings within that bundle and maybe has, a corporate operating system that they can get everybody on and add some synergistic qualities between the locations. So services are doing very well. The expectations associated with those businesses have come up a lot. But if you go into one of those traditional deals that is commonly referred to as a roll-up, if you get approached to be part of a roll-up as a business owner, the trade-offs are that you're going to have to adhere to whatever that corporate system is going to be. It's probably not going to be your brand name on the door anymore. It's going to be theirs. And you'll likely have a changeover in management because their ambition is to scale it to a point where it either can be sold to a public company or sold to big private equity, in which case it'll be operated pretty substantially differently. On the other side, you have consumer goods, and consumer goods are not doing well right now. And a large part of it is that some of the headlines you saw in the public markets, retailers were gluttoned with inventory at the end of last year.
I got some Target pants for cheap.
I'll take a slightly different view, which is looking at it by industry is absolutely one way to do it. But we have another saying that we often say around here, which is like, you're not necessarily your industry, but you are your business model. And so if you're a business that's feeling a lot of stress right now, regardless of the industry you're in, it's easy to point at the industry and be like, oh, we're in capital goods. We're all down right now. That's not necessarily lazy, but if you're feeling a lot of stress right now, you probably have a challenging business model. And if you're feeling less stressed right now, there are capital goods businesses that are doing better, and it's because their business model is probably more refined. And so when I say business model, what I mean is, hey, when do you get paid by your customers? Do you get paid up front, or do you get paid 90 to 180 days after the fact? Do you take possession of a ton of inventory, or do you have inventory on demand? Emily alluded to margins. Like, do you have pricing power? Like, do people, if you were to go away, would your customers actually miss you, or could they replace you? Those are all kind of fundamental businessy model questions that every business owner should ask themselves to help facilitate an understanding of the current environment, which is, hey, if I'm challenged right now, why? Now, some things you can't fix, right? Like if you're a subcontractor that works for large general contractors and they're not going to pay you any faster. You're just in a tough business and you got to take your licks.
Kind of grind through.
Right.
Yep.
We're having some work done on our house right now. The contractor's a great guy. He's been out there for 2 weeks doing stuff. He hasn't asked me for a check. I've been like, hey, can I give you money?
Can I approve your business model? You should ask me for money.
You should ask me for money. Like, I would have given you a deposit.
Yeah.
And I think especially for very small business owners who don't necessarily even have the time to think about that stuff, it's important to like take a day and just go, hold on a second. What are my customers willing to bear? And it's not unfair to ask me to pay a deposit. Like, he has working capital. He's paying his guy.
Right.
Absolutely it's fair. Don't be unfair, but be fair.
I mean, the coffee shop across the street, it's my favorite coffee, but they charge me $9 for a cup of coffee. And we're in Columbia, Missouri. We're not New York and the coast here.
They found a niche, though. That place is hopping.
I still pay it.
I
still go.
It's a place to be seen. You're not cool unless you're over at
They have pricing power
It's
over
Cola.
David.
A Cola now.
Right across the street. Wonderful
Three-story,
coffee. Onyx
yeah.
Coffee out of Arkansas. The best in the world, in my opinion.
So they have pricing power over you?
They have it over me, and I'm ready to pay.
No free ads. If we're gonna name drop Onyx Coffee,
I'm going to bleep that out.
we're sending them a bill.
That's exactly right. Okay, so are there any other spaces you're seeing facing particular challenges?
What's happening right now is that everyone's looking at it from the standpoint of what is reality?
That's
Where
right.
are you, right? And where have you been over a full cycle? So that's where 2020 can be taken with a grain of salt, and 2021 will probably be taken with a grain of salt as well. And you'll average the two and have the conversation at that point. And I think that it opens the door to conversations that are more around risk sharing and how you look at the future, because, something that we often have to talk with business owners about is they have more information and greater confidence about their future performance than we ever will.
Right.
It leads itself to lots of conversations about how to structure a deal that makes sense in these types of market conditions, which again is like a return to normal. It just hasn't felt normal for 3 years at this point. So a lot of people are entering the market having not heard terminology like structure to a deal, which is an important piece and has been historically to solving for risk between parties.
Okay, correct this thought that I'm having. I've seen what's been going down. I have a friend who sold a business a couple years ago last year. The psyche of what I'm feeling right now is, okay, this is going to be a hard time for me to get what I think my business is worth. I'm just going to batten down the hatches and try to come back out on the other side of this and get the higher multiple that my buddy got. Do you think that's a fair thought to have?
To the point I was making earlier, you have to think about your situation in the context. And you also have to think about the time value of not just money, but of your energy, your interest, the things that you want to do. And batten down the hatches, right, is a nebulous elongation of time, right? Fast forward 2 years, 4 years, 5 years. Let's say that capital gains rates have changed. Let's say that the gift tax exemption has changed. Let's say that estate taxes have changed. Let's say that interest rates don't go down. Let's say
Not
that you
to
have
even bring in global events and world wars and
or even, let's say you have a health crisis,
Right.
or you have a
Yeah.
health crisis in your family.
your personal life. Yeah, that's right.
If you're ready emotionally, physically now to start the process, again, if you sell a business, now you've got to pay taxes and you got to find something else to do with the money. I take your point. Your headline valuation is probably going to be lower this year than your buddy's was in your example 2 years ago. But when you mix all the ingredients of a successful transaction and transition together, I think the environment in some ways is more favorable because you've got very favorable tax laws for the time being. You have an environment where it's easy to make other investments to diversify. And, if you've got other things you want to do with your time, which I think is usually the number one motivation for people selling, is that they would just want to do something else and have a plan for the future.
Or they want to stay in the business and do what they love within the business.
But
Right.
have some sort of...
Not operated.
Right. Not doing that has a cost too. And I think a lot of times and all of us do this in our lives, which is we see visible costs and we kind of ignore the hidden costs of things. And, but those things do actually take their toll.
I think it's incredibly unlikely that people are going to pay what they paid in 2021 anytime soon from an investor standpoint. The organizations that were hyper aggressive in that market and paying the really high valuations, a lot of them are in crisis control at this point in time. And it was a hard lesson to learn. And they would tell you, I mean, I have friends in those firms who will say, we'll never do it again, and
well, overpaying for something is like one of the most stressful things you can do as an investor, or even like the people who bought houses in 2007. I mean, some of them are still underwater. And it's a hugely stressful thing to have that loss hanging over you, and it manifests itself in lots of weird ways on a business. In some ways, I think it's worse than debt.
There probably was a period of time in which you were top ticking the market, and that was likely in 21, and it's likely not to be seen again soon. So optimizing for something that may not happen again seems like you're betting, as Tim pointed out, like against your health, against your interests, against how you want to spend your time, all of those types of things. And I think the other condition is there are still lots of firms, us included, who have money that we would like to put to work. And so in that way, you have a willing set of investors and people who want to partner genuinely, who are extremely eyes wide open about the current market conditions, and to use the term we use internally, like shovel the shit alongside you through market conditions that are not eternally positive. So I think in that way, like if you just want a bigger sounding board, if you want more people in the boat with you, like there are lots of reasons to say this might be a good time to at least initiate conversations and then talk about what it is. Because the point on structure is the conversation of how much do you want to take now and how much do you want to bet on the future, right? Because cash now is an exact value for what the buyer feels is there at that point in time. But you can always say, like, I'll take more money, but I'll take it later and do it with some sort of structure around performance indicators for the business. And you may see that that's the best path forward for you. So it's really, in that way, I would encourage people that sort of are thinking about it just to initiate conversations, knowing that there's not one way to sell a business and you don't have to sell for cash today in order for it to make sense.
I suppose I still want to keep my cynical sneakers to use the skeptical skirt. I'm wearing a skeptical skirt.
Did you get that at Target?
Is that good?
For 50% off?
So if you're wearing that skirt, the other thing to know is our values haven't changed because we don't use the leverage.
Yeah, okay.
So
right.
We were making the same offers in 21. We were just
getting outbid by people.
Well, we were being laughed at.
Right.
Right. I mean, it was an interesting market in which to do deals. And we still successfully made investments during that time, and we've successfully made investments throughout this period. There were crazy offers being made. I think the point is that our offers and the way that we've underwritten businesses has been consistent throughout this period. And because we don't use the leverage, we didn't have to come down 2 turns on what we were offering because the banks changing their rates doesn't affect us.
The reason that the rates of the banks don't affect us is because we don't use debt in the deals that we're
We don't use other people's money, where a lot of other investment firms are cobbling together multiple classes of capital to make a deal. So
they can offer a higher valuation to your business because they have
a diverse set of funding, all of which has different costs associated with it. So there's bank debt, there's mezzanine debt, there's equity capital. These are all places you can go find money, and these people will give you money for different costs, right? Because we're only using our own fund capital, the cost of that capital has been consistent, to Emily's point, every year.
And as an owner, operator, seller of this business, why do I care how you got your money?
So Q4 was a perfect illustration of this. I mean, I just finished going through at the turn of the year. We always have lots of conversations with advisors on how did their year end up? What are they bringing to market this year? And what's their sentiment on market conditions? And I haven't had this many conversations about broken deals in the recent history. Like, I can't remember the last time I had this many conversations about it. And so a lot of deals were broken in the fourth quarter. What ended up happening mostly was that banks pulled back and said, we will not lend. So then they'll look to mezzanine. Well, they take a much higher premium, like 14 to 17% interest rates. So why you would care is that the way that that is going to be funded means that the earnings of your business are largely going to go to pay interest, period, in order to get that deal to actually functionally close, if it closes at all. So you've got a higher risk that your transaction never closes. And if it does close, your interest costs are significantly higher than likely what you thought they were going into the transaction.
And so because my profits are going to pay down that debt, that's what typically leads to the layoffs and the other things that we see in some of these horror stories of private equity.
It limits your optionality. You can't reinvest for growth. You can't do
Well, it's other
things.
people's money.
Right.
And those people would like to get paid back, which is a hard reality to confront sometimes.
So they'll have covenants on how you're going to operate. Conditions in the market may change, but you may have to operate the same way because that's what...
It's the equivalent of if you're a homeowner who bought a house in 2007 you overpaid and used an adjustable rate mortgage. And now 3 years hence, the value of your house is down, so you can't refinance, and interest rates have gone up, and so your interest payments have now doubled. You have to cut costs some way or they're going to come take your house because it's not your money.
Can I not just vote to raise the debt limit, though?
You can go try to work it out with your banker, which is where that analogy is going. And they have
And
interest
sometimes
as well.
they will. Yeah.
Because they don't want to write off a bunch of bad loans. But those conversations are, I don't know, those have never struck me as a good use of time. To Emily's point, there are lots of other things you can be doing than figuring out how to navigate how not to default.
Okay, so I've learned a ton in this conversation, and I just want to keep my skeptical skirt on with my cynical sneakers for just one more question. Do we not have a conflict of interest in sharing our perspective today?
Look, yeah, everybody in the investment industry is trying to generate returns, and we're no different, right? It's how we get paid. It's a completely fair question. I think the difference between the offers we make and offers that have different structures to them is that we are seeking to generate our return after we make the investment. So we want to work with the businesses, we want to work with the customers, the suppliers, the employees to help build a better business that earns a return over a very long period of time.
The reason that I thought that this would be a worthwhile conversation is that most people turn to advisors to have this conversation. And they say, hey, what's the market doing? Should I sell now? Should I sell later? And those people also have incentives. Their incentives are different than ours. To your point, yes, we want to put money to work. Those people are incentivized to sell your business for top dollar, period. And that's how they get paid. More than likely, they may take a small retainer, but it's a contingent success fee based arrangement. And in that, they will make the market in such a way that they just want the deal.
It's like a sports agent in some sense.
Correct.
That agent wants the big deal.
Right.
Sometimes
And so,
to the detriment of the player's
well,
future
so I
and
had conversations
circumstances.
with a few people who said, man, I got that deal done. And then I heard that 2 weeks later, they furloughed half the staff. And to my knowledge, they haven't hired them back. And it's like, well, congratulations, you got paid, but that operating entity, their culture's damned. Like it's in a horrible place. And so those are the types of things that, like, when we say we just want to have genuine conversations and we want to do fair deals, by and large, there were some times in 2021, to Tim's point, where we got laughed at. But by and large, like, we're in the realm of reasonable, and we're usually with the pack. And what I mean by that is that if you ran an auction, it sort of looks like a bell curve. Most of the people are in the middle in terms of how they're valuing the business. And then there's going to be the outlier that's willing to pay 10 or 15 or maybe even 25% more. But you have to look at what the trade-offs of that are. And I would say that we're towards the top of the bell curve on most things. So, I think incentives are what they are. And our point is not that you should only listen to us. It's just that we are in the position where we actually do write checks. And so we can tell you from that standpoint how we are underwriting those things and how we're thinking about them. And then the final thing I would say is, like, if you're trying to figure out what the bell curve looks like and how to think about structure, getting paid now or getting paid later, I would encourage people to check out the instant appraisal tool. We've plugged it a few times, I think,
Where
on the
can
podcast.
you get that?
So that's on our site under the resources tab.
Permanentequity.com, click resources, and it just should say
And
instant
it says,
appraisal.
It says instant appraisal.
And what will they get there?
Tim's actually the one who
It's
drafted
really well
it.
designed.
Tim designed it, I hear.
Really well
But
designed.
it's a risk-weighted calculator, and you enter a bunch of inputs. That
What
it gives
might
you.
other people think of my business?
Right.
And the inputs are things like your earnings history, your earnings quality, your volatility. It tries to assess kind of the complexity of your situation by asking some questions around, like, how many people would have to agree to a deal and
Right.
so on and so forth. And so there is some nuance to
Where you're located, like
Yeah.
all of those things.
know.
And so you end up with a bell curve. It literally spits out and tells you at one end of the range, maybe your business is worth 20 million. And at the other end of the range, maybe it's worth 35 or 40. And the difference between those things, it tells you, sort of these are the things that you can potentially
tries
work
to make a
on.
few helpful suggestions.
But still wearing my cynical skirt. Is this just a way to collect their data?
No, we don't collect the data unless
Okay.
you send it to us.
Okay, so they can opt in to send it to us.
Yeah, there's just a button that says
Very
send
good.
to the permanent equity team. But otherwise, it's just a free resource for advisors and for owners just to get a pulse on, how to think about that range of options.
The valuation calculator sounds really helpful. Maybe I'm someone who is ready to start having conversations. I've not done this before. I think a concern I could have is as I start to navigate this, put my information out there, have these conversations with people, is the concept of confidentiality. Can you just walk me through what that looks like, what the standards are for that?
Just have a conversation with us, and you can keep things very high level and then decide whether you want to sign an NDA and want to have us sign an NDA. So it's usually mutual. And at that point, we'll ask you for information. We'll ask you for financial information and some basic operating history around the business. And you can always choose to share summary versions of that. You just have to also recognize that the information withheld until a later date will also impact how strong of a decision we can make on our, sort of valuation and path forward.
Now, that said, I would add, if we're going to actually make an investment, we're going to find out a lot of information about the business. And so
that's called diligence, the diligence process.
Correct.
Yeah.
And so I would say it's fine to stagger the amount of information that we're provided. But to Emily's point, conviction and disclosure are directly related to one another. But if we learn something at the beginning that turns out not to be true, obviously that's problematic. And so again, at the risk of talking our own book and advocating for our own interest,
well, we are on our own podcast right now.
we would prefer, more sooner.
Yeah.
If someone is willing to do that, just because it makes sure that nobody wastes time, and time is the most valuable resource we all have.
Well, just to illustrate that point, it's like we can make an offer and say, we think your business is worth $45 million. And then you say, oh, did you know, though, that I sold the building in a 20-year lease back that the business is obligated to. And
I don't own the IP anymore.
And I sold the IP, and we're in 3 lawsuits around these 3 things. And it's like, well, it's not worth $45 million then, right? So skeletons, to Tim's point, do need to be disclosed if you really want a credible valuation.
But what I hear, and I've never sold a business.
Are you going to try to sell this podcast?
I'm gonna monetize this with Onyx Coffee. And then
Bentonville's
who
finest.
owns the intellectual property is what I want to know. But what I've heard, though, is you use the word skeletons in the closet. Those exist in every company, right? Like every company has
Absolutely.
the
There is
issues.
no
So it's
perfect
not
company.
I shouldn't approach anyone because I got this stuff over here. My house is not quite in order that they're going to want it to be. That's not what you're saying.
No, absolutely not.
Yeah.
There is no perfect company. We've never seen a company that isn't going through issues, but the magnitude of the issues, the obligations of the business that would exist after a transaction, those are things that we do need to understand.
To use your house analogy, you're trying to sell your house and the roof is busted.
Right.
You can try to go put a new coat of paint on it and hope nobody notices.
Yep.
Somebody's probably going to figure it out, right? Eventually, at which point the negotiation around fixing the roof or getting a allowance to fix it is going to be more contentious than if at the beginning you just said, hey, by the way, I know you love the house. The roof does need a repair. Can we be thoughtful and fair around what that looks like?
There are 3 dead bodies in the attic. I hope that's okay.
I've only killed one of them.
To use a really painful example from a friend, they bought a house that had flooded multiple times and the sellers didn't disclose it. They successfully made it through, but they also said in the contract that it had never flooded, and so they were able to sue them. So you don't want to try and get a fast one by somebody because it will come back to haunt you in some way.
Again, I've never sold a company. I don't know the process. I actually have a challenge for the 2 of you in as high level.
Like a physical challenge?
I want you to do wall sits while I ask this question.
I can't do this today.
At a high level, as short of a sentence, can you summarize from I reached out and we started a conversation to we've closed on a partnership? Can you summarize the process to me?
I would say that we tried to understand the business, ask questions about how it operates, what you envision the future to look like, and what the history has been, and who's involved. And then we look through your financials and put forth a rough idea of valuation. If that's interesting to you, then we want to meet in person, spend time together, see if we all like each other, see if we're interested in spending more time together, and in refining that valuation into something that we all want to move forward on. At which point we put a letter of intent in place, which means that we're engaged. And there's a closing date sort of set, maybe not a firm date like a wedding date, but pretty close in terms of timeline. And so we're working towards that together, which is diligence. So it is sharing all the information that we as the buyer will need to see to confirm that things are what they are and they're organized the way that you said they were. Then at that point, we move forward to closing. Closing is when wires are actually transferred, purchase documents and operating agreements are signed, and then we're partners.
I would say discovery.
Okay, that's good. I like one word categories.
Proposition, negotiation, validation.
That's diligence?
Lawyers.
That's diligence.
Close. Discovery, proposition, negotiation, validation, lawyers. Close.
Try and keep the lawyer time as small as possible.
Small as possible?
They infest you though. They just get their hands in everything.
One of my favorite people on our team is the lawyer. So I don't know. We got a good one.
Well, we all love Taylor.
A nice one. Taylor, yeah.
No, and Taylor's extremely good at what he does, but it's also...
He's great for a lawyer.
What I mean by that is there are lawyers who will try to make sure that they spend as much time on the deal as possible when the point of bringing in the lawyers is to get the deal done. So
someone might be paid hourly is what I'm hearing you say.
Well, you always got to be aware.
Usually do get paid hourly.
People know where their incentives are.
Yes.
And if you as a client want to close a deal and you're paying your lawyer by the hour, you are potentially at loggerheads.
Right. And that's where Taylor is incredibly efficient. He is not trying to spend the maximum amount of time.
Because we don't pay him by the hour.
Okay, last question. You've brought up all these other entities of my options available. Without strawmanning, what would they say to our value proposition and why they're a valid alternative?
I mean, honestly, the biggest competition to us and a value proposition that honestly we can't beat is just keep it. Figure out a way to keep it. Right? Set up your own transition plan, your own succession plan, keep your equity, make sure that it generates cash flow for you and your family, and turn it into a multi-generational enterprise. There's no friction. There's no taxes. Like, that's a really hard value proposition to compete with. Now, there are a lot of reasons why people can't do that, but you said don't strawman, right? Like, if you can figure that out, that's great.
Thanks for listening. We hope that today's episode was helpful for you if you are someone who's trying to figure out what comes next for your company. You know, the valuation calculator they talked about at permanentequity.com is a great tool for you. Or you could reach directly out to Emily at permanentequity.com, just one letter permanentequity.com, and just start that conversation with Emily. If you're not an owner of a company and you stuck with us through this conversation, we got a lot more coming that I think will be more relevant to you in your life. We've got more outside insights, people from outside Permanent Equity sharing their insights in and around the SMB space. We've got a new Hariharan.
I haven't seen yet at a stage of the company where you could say, hey, let me just hire for a manager and not a builder. Because I think having that builder mentality goes a long way, no matter how much you scale. But I think just because you're a builder, if you're a roadblock to scaling, that's bad.
Also got Chris Powers.
I've never shed a tear on a podcast, and I'm not about to do it.
John Fiorentino.
Quick story is I made a fake website. Said this is a new thing. It's kind of like an exclusive Airbnb for dope dudes. In 2 days, I got 500 signups. And for a year and a half, I went to go stay on their couch, and I basically would show up, be like, yo, what's up? I'm the dope dude. And that was how I lived for like 2 years. And then boom, Kickstarter happened. I dropped Gravity Blanket, and I literally went till waking up with a couple $1 million in my bank account because Gravity went viral.
We've got more 5-minute managements as well, but I want to tell you about a new daily newsletter that we're launching. It's with our very own Tim Hanson, and Tim is joining me right now. Tim, what is this newsletter? Who's it for? What are you doing?
Well, first, thanks for the opportunity to hype myself. The newsletter.
Never turned down an opportunity to hype myself.
The newsletter is called Unqualified Opinions. It's really for anybody, and it's just meant to be something daily that I found interesting. Usually going to be around risk, reward, things that are working, things that aren't.
This comes back from your exercise as a playwright major where you had to write 1,000 words every morning by 9 a.m.
Well, I've seen people bragging on Twitter about how much they're getting out of writing regularly, and I said, you know what? I used to be able to do that. Let me see if I can do it again.
And you have unqualified opinions.
I have lots of unqualified
And here we are.
Exactly.
Where can people subscribe to this? You can go to permanentequity.com.
Yep.
And we've got a spot under our resources tab at the very bottom called Unqualified Opinions. Get your daily dose of Tim in your inbox. Maybe some guests will join on that too whenever you need to take a break.
That's right.
Permanentequity.com. Go to resources at the very bottom. Unqualified Opinions with Tim Hanson. Thanks for sticking with us. Until next time, my name's David. Have a great day.